As the U.S. market is currently closed, we're looking at the figures from the end of yesterday's session, November 3, 2025. Kenvue, ticker KVUE, closed the formal trading day at $16.16. In after-hours trading, it edged up slightly to $16.20. Now, if you were just casually glancing at those numbers, you might not grasp the sheer chaos and magnitude of what happened. That closing price of $16.16 wasn't just a normal day. It represented a massive surge of over 12% from its previous close. This wasn't a drift. This was an explosion. And it happened because the entire investment thesis for Kenvue, the entire story, was completely rewritten in a matter of hours. The reality of this company was fundamentally altered by a single press release, making every prior expectation obsolete. The general belief about Kenvue up until yesterday morning was one of cautious, perhaps even slightly pessimistic, patience. This was the consumer health giant spun off from Johnson & Johnson, holding an incredible portfolio of brands like Tylenol, Listerine, Neutrogena, and Band-Aid. The expectation was that this new, independent company would be a slow, steady, dividend-paying stalwart, but it had a rough start since its IPO. The stock had been weighed down by debt, litigation fears inherited from its parent, and a general consumer spending malaise. Investors were looking for stabilization, for proof that this standalone entity could manage its costs and grow its iconic brands in an inflationary environment. The expectation was a long, slow grind. That was the narrative. Then, reality hit like a freight train. Kimberly-Clark, the parent company of Huggies and Kleenex, announced it is acquiring Kenvue in a massive deal valued at approximately $40 billion. This is the kind of development that changes everything. The deal, a mix of cash and stock, values Kenvue shares at $21.01 each. Let's just pause and think about that. The stock closed at $16.16 after surging 12%, but the actual buyout price is $21.01. This implies there is still significant ground to cover before the stock price reflects the acquisition value. The immediate market reaction was, naturally, a frantic repricing. Volume on KVUE went absolutely parabolic, trading more than 200 million shares, a stunning figure compared to its 30-day average of around 37 million. This wasn't sophisticated, quiet institutional accumulation. This was the entire market trying to process the news at once, with algorithms and retail traders using platforms like the Robinhood app or SoFi Invest piling in, trying to capture the arbitrage gap between the trading price and the acquisition price. It's a classic merger arbitrage scenario, but with a twist. The reason the stock didn't immediately jump to $21 is because no deal is truly final until it closes. There will be regulatory hurdles, shareholder votes, and the fine print to examine. The market is pricing in the risk that the deal somehow fails. What makes this timing so fascinating is that this acquisition news completely overshadowed Kenvue's own third quarter 2025 earnings report, which was released at the same time. On any normal day, that earnings report would have been the only story. And frankly, it was a mixed bag that perfectly fit the old narrative. The company reported revenue of $3.76 billion, which was actually down 3.5% year-over-year and missed analyst estimates. However, its earnings per share came in at 28 cents, slightly beating the consensus estimate of 27 cents. This is exactly the kind of meh report that would have left investors feeling uncertain. Sales were down across its self-care, essential health, and skin health segments. It pointed to that consumer weakness everyone was worried about. If this earnings report had been released without the acquisition news, we would likely be talking about KVUE stock facing pressure, not surging. This is the ultimate example of expectation versus reality. The expectation was that we'd be picking apart sales figures for Tylenol. The reality is that none of those specific quarterly metrics matter anymore, at least not in the same way. The company's future is no longer its own. It's about to be part of Kimberly-Clark. Let's quickly detail what Kenvue actually is for those who might be new to the story. Kenvue is the world's largest pure-play consumer health company by revenue. It was spun off from Johnson & Johnson in 2023, a move designed to separate the high-growth, higher-risk pharmaceutical and medical device business from the slower, more stable consumer brand portfolio. We're talking about legacy brands that are in almost every household in America: Neutrogena, Aveeno, Listerine, Band-Aid, Tylenol, and Motrin. These are powerhouse names. The business model is simple: build and maintain massive brand loyalty for over-the-counter products, command premium shelf space at retailers, and generate consistent, reliable cash flow. That cash flow was meant to service the debt it took on during the spin-off and, crucially, to pay a hefty dividend, which it was yielding at over 5%. This made it a target for income-focused investors who might use a Fidelity brokerage account or Schwab Intelligent portfolios to build a diversified income stream. The problem was that since its IPO, the stock had performed poorly, drifting down from its initial offering price as investors fretted about lawsuits, particularly those related to talc, and the company's ability to innovate beyond its legacy products. The acquisition by Kimberly-Clark, KMB, is a strategic earthquake for the entire consumer defensive sector. KMB, itself a giant in paper-based consumer products like Kleenex, Scott paper towels, and Huggies diapers, saw its own stock, KMB, drop about 16% on the news. This is a classic reaction. The acquiring company stock often falls because it's taking on new debt and the perceived risk of integrating such a massive new entity. KMB is effectively making a huge bet that it can create a $32 billion global health and wellness leader, finding synergies, cutting costs, and leveraging the combined brand power. KMB investors are clearly nervous about the price tag and the execution risk. But for Kenvue investors, it's a lifeline. It's an exit. It's a validation that the underlying assets, the brands, were indeed valuable, even if the public market was struggling to price them correctly as a standalone company. This isn't a high-growth tech story like we see with Nvidia stock, or even a brand ecosystem play like Apple stock. This is a consolidation play in the old-world economy of bathroom cabinets and medicine chests. So where do we go from here? The future outlook for Kenvue is now almost entirely tied to the acquisition's closing. The timeline for a deal this large is typically many months, potentially stretching into 2026. Regulators, particularly the FTC, will have to scrutinize the merger for anti-competitive concerns. Will combining the maker of Kleenex with the maker of Band-Aid create a company that has too much power over retailers and, by extension, consumers? That will be the central question. Investors who own KVUE stock now have a new set of calculations to make. Do you sell today and take the 12% gain, locking in your profit? Or do you hold on, believing the deal will close, and wait to capture the full difference up to $21.01? Holding on carries the risk that the deal is blocked or delayed, in which case the stock price would likely collapse back to its pre-deal levels, or perhaps even lower, as the company would then be left on its own after its mixed earnings report. This is a decision that requires careful consideration of one's own risk tolerance. Many investors managing their own portfolios through online investing sites or using investment help from a service like Fidelity Wealth Management will be weighing these options right now. The analysis of Kenvue has transformed overnight. We are no longer analyzing channel inventory, marketing spend, or consumer sentiment toward skin health. We are now analyzing antitrust law, deal financing, and shareholder sentiment at Kimberly-Clark. This is a complete pivot. For those who held the stock through its painful decline, yesterday was a moment of sudden, dramatic relief. For those who were shorting the stock, betting on further decline, it was a catastrophic event. It shows how quickly the fundamentals can be rendered irrelevant by corporate action. It's a brutal reminder that investing, whether in hyped names like Tesla stock or seemingly boring stalwarts like Kenvue, always carries event risk. Some investors might even be looking at this as a time to move on, perhaps taking their Kenvue profits and redeploying them into other assets, maybe through a platform like Interactive Brokers, which offers access to global markets, or even into different asset classes like those offered by Robinhood Crypto. I'm curious what you all think about this sudden shift. For all the Kenvue shareholders watching, comment below with what your plan is. Are you selling and taking the profit, or are you holding for the full $21.01 acquisition price? It's a fascinating strategic dilemma. In summary, the Kenvue story is a perfect illustration of the tension between expectation and reality. The expectation was a long, slow, boring recovery for a dividend-paying consumer staples company. The reality, delivered yesterday, is a $40 billion buyout that instantly reprices the entire company and changes its future. The stock's massive surge yesterday was the market scrambling to catch up to this new reality. The mixed Q3 earnings report, which would have been the main story, became a mere footnote. The focus now shifts entirely to the complex process